Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points highlighting the key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at the ISM Services and Orders PMI. In point number 3, we'll take a look at the jobs report. And in point number 4, we'll take a look at the University of Michigan's Inflation and Sentiment Survey. Now, on to point number 1, the market recap. First, each week we look at the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta Fed GDP Now report shows a healthy 2.9% growth as of February 7th. This is unchanged from last week. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of the labor market. This week, initial claims data rose by 12,000 claims, ending at 219,000, while continuing claims also rose to 1.886 million. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement in the 30-year and 15-year mortgage rates, ending at 6.89% and 6.05% respectively. I've updated the chart on your screen to reflect mortgage rates, median existing home sale prices, and sale prices for new homes. This set of data provides additional context to our affordability discussion. As shown, the U.S. existing home sales median price was $404,000, and new home sales was $427,000 in January. Next, we'll look at investor sentiment. One component of investor sentiment is the measurement of the bull-to-bear spread. The latest update shows the bull-to-bear spread fell from a positive 6.93% last week to a negative 9.52% this week. Investors are feeling more bearish with the current market. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating an 8% probability of a 0.25% decrease and a 92% probability of no decrease in March. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 0.53%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 0.95%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was positive 2.14%. International stocks took the win again this week. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. Now on to point number 2, the Institute of Supply Management data. The Institute for Supply Management, or ISM, released its January Services Purchasing Managers Index, that's a mouthful, or the PMI, which came in at 52.8. This was below the forecast of 54.2 and also down from December's reading of 54. Despite the miss, the reading still indicates a 7th consecutive month of expansion in the services sector. A PMI reading above 50 signifies growth in the services sector, and it's important to note that the services sector accounts for more than 2/3 of the U.S. economy. The report sub-indices were mixed. The Business Activity Index fell to 54.5, down from 58.2 in December, and the New Orders Index fell to 51.3, which was also down from 54.4 in December. These declines contributed to the lower composite index reading. However, the employment index rose to 52.3, up from 51.3 in the previous month. This indicates that the services sector labor market improved in January and remained in expansion territory. Now, inflation pressures moderated the sector, with the prices index decreasing to 60.4 in January from 64.4 in December. This is a hopeful sign, as progress is bringing inflation down to the Federal Reserve's 2% target, and this has stalled in the recent months. However, the outlook for inflation remains uncertain due to the potential U.S. government tariffs and the tariff actions, and mass deportations, which some economists have warned could raise prices. The U.S. Central Bank has reduced its policy rate by 100 basis points since September, and as we discussed last week, the Fed's left this rate unchanged. On to point number 3, jobs data. In January 2025, private sector employment saw a significant increase with 183 jobs added, according to the ADP National Employment Report. This figure exceeded economists' expectations and the revised December total of 176,000 jobs. The service providing sector, which is the main driver of this growth, added 190,000 jobs, while the goods producing sector experienced a net loss of 7,000 jobs. Within the services sector, trade, transportation, and utilities saw the largest gains of 56,000 new jobs. Manufacturing within the goods sector saw a net loss of 13,000 jobs. Payrolls also saw growth, with a 4.7% annual increase for employees who stayed in their current jobs. Employees who changed their jobs experienced even higher increase with a 6.8% rise in pay. ADP's Pay Insights measure, which tracks these changes, now captures nearly 14.8 million individual pay change observations monthly, which is a significant increase from the initial 10 million. This report indicates that consumer-facing industries are driving hiring, while business services and production are lagging. Job growth varied across different regions in the United States. The West saw the largest increase with 70,000 jobs added, while the Northeast saw the smallest gain with 22,000 jobs. Medium-sized businesses, or those employing between 50 and 499 workers, added the most number of jobs, with 92,000 new positions. Small and large establishments also saw employment gains. Now on to point number 4, the University of Michigan inflation and sentiment data. Consumer sentiment has been declining, reaching its lowest level since July of 2024, according to the Michigan Consumer Sentiment Index. The index fell by 4.6% in February to 67.8, which is also 11.8% lower than a year ago. The decrease in sentiment was widespread, affecting all political affiliations, age, and wealth groups. The index consists of 2 sub-indices, the Current Economic Conditions Index, or the CECI, and the Consumer Expectations Index, or the CEI. The CECI dropped to 68.7%, a 7.2% decline from the previous month and a 13.5% decline from a year ago. While the CEI fell to 67.3, which is a 2.9% decline from the prior month and a 10.5% decline from a year ago. These declines indicate a weakening of both consumers' current views on the economy and their future outlook. Several factors contribute to the decline in consumer sentiment. Expectations for personal finances have fallen to their lowest level since October of 2023. Consumers are also worried that high inflation will return within the next year. In February, year-ahead inflation expectations jumped to 4.3%, the highest reading since November of 2023, and a significant increase from the 3.3% reading in the previous month. This is the 5th time in 14 years that there has been such a large one-month rise of at least 1%, 1 percentage point in a year-ahead inflation expectations. Additionally, there has been a 12% drop in buying conditions for durable goods, influenced by a perception that might be too late to avoid the negative impacts of tariff policies. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest video on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you again for watching. We look forward to seeing you next week.